Welcome back to Veiled Wealth. If you were to judge the health of the global economy solely by looking at the headlines on CNBC or Bloomberg this morning, you would be forgiven for thinking we are entering a new golden age. The numbers, on the surface, are nothing short of spectacular. The S&P 500 isn't just making new highs, it is smashing through psychological ceilings that pundits said were impossible just a few years ago. The Dow Jones Industrial Average is trading at levels that defy gravity. Corporate earnings are being celebrated. Unemployment figures are being massaged into improved optics, and the narrative from the White House to Wall Street is uniform. The soft landing has been achieved, the crisis has been averted, and the good times are here to stay. But if you are watching this channel, if you are part of the Veiled Wealth community, you know that the official narrative is rarely the whole truth. In fact, right now it is a dangerous distraction, because while the public is being lulled to sleep by rising stock tickers, a completely different story, a much darker and more urgent story, is unfolding in the plumbing of the global financial system. Look at what the smart money is actually doing. Look at the insiders. While retail investors are piling into tech stocks and passive index funds at record valuations, the world's central banks are doing something they haven't done in generations. They are fleeing the very fiat currencies they issue. In the last 12 months, we have witnessed a historic anomaly. Gold prices have surged over 66%, the most violent upward move since 1979. Silver, the restless sleeper of the precious metals market, has awakened with a vengeance, exploding more than 140%. These are not standard market fluctuations. This is not normal volatility. When the safest assets in the world, gold and silver, start moving like volatile cryptocurrencies, it is the financial equivalent of the ocean receding before a tsunami. It is a signal that the tectonic plates of the monetary system are shifting. So, here is the question we need to answer today. If the dollar is strong, if inflation is conquered, and if the economy is booming, why are the institutions with the deepest knowledge of the system panic buying real assets? Why did the National Bank of Poland recently announce a strategic pivot to hold 30% of its national reserves in physical gold? Why has China aggressively stockpiled gold for 18 consecutive months while dumping U.S. treasuries? Why are the billionaires, the Zuckerbergs, the Bezos class, selling billions of dollars of their own stock to buy land, bunkers, and commodities? They know something is coming. They are positioning themselves for a specific event that was predicted 50 years ago by a man who helped build the system we are using today. His name was John Exter, and understanding his warning is the key to preserving your wealth in the coming storm. To understand the magnitude of what is happening, you first have to understand the man who drew the map. John Exter was not a YouTube personality. He wasn't a newsletter writer selling subscriptions, and he wasn't a doom-mongering survivalist. John Exter was the ultimate insider. He was the definition of the establishment. Born in 1910, Exter came of age during the Great Depression. He watched firsthand as the Roaring Twenties, a time of easy credit and soaring stocks much like today, collapsed into a decade of poverty and despair. He saw how quickly paper wealth could evaporate. He saw that when the banking system fails, the only thing that matters is what you physically own. These experiences drove him to Harvard University, where he dedicated his intellectual life to studying the anatomy of financial collapses. His brilliance landed him at the Federal Reserve, but he wasn't just an analyst. After World War II, John Exter served on the Board of Governors of the Federal Reserve System. He was then tapped to essentially build the monetary systems of foreign nations from scratch, founding the Central Bank of Ceylon, now Sri Lanka, and serving as its first governor. Later, he became the senior vice president of the Federal Reserve Bank of New York. This is a critical detail. The New York Fed is not just another bank. It is the operating arm of the Federal Reserve. It is where the gold vaults are. It is where open market operations happen. John Exter was in charge of international banking and gold and silver operations. When gold bars moved between sovereign nations to settle debts, John Exter was the man overseeing the ledger. He knew where the gold was buried because he held the shovel. And from this vantage point, deep inside the machine, Exter saw a fatal flaw. He saw that the post-war monetary system was designed to expand indefinitely through debt. He realized that for every dollar of real wealth created, the banks were creating $10, $20, $50 of paper claims, credit, loans, derivatives. He knew that, eventually, the weight of the paper claims would crush the foundation. To explain this fragility to the world, Exter created a visualization that has become legendary among contrarian investors, Exter's inverted pyramid. Imagine an upside-down pyramid balancing precariously on its tiny tip. This shape represents the global financial system. The width of each layer represents the total dollar value of that asset class. At the very top, the widest, most massive, and most unstable layer, Exter placed derivatives. Below that, unfunded government liabilities. Then, stocks and real estate. Then, government bonds. Then, cash, Federal Reserve notes. And finally, at the very bottom, the tiny tip supporting the entire structure: gold. Exter's thesis was simple but devastating. In a healthy economy, capital flows upwards, seeking yield and risk. People sell gold to start businesses. They sell cash to buy stocks. But when the debt cycle turns, when the confidence that holds the pyramid together cracks, the flow reverses. Capital doesn't just disappear, it flees. It creates a liquidity drain. Investors panic sell the risky assets at the top to buy the safer assets below. They sell derivatives to buy bonds. They sell bonds to buy cash. And finally, when they realize the cash itself is being debased by inflation and money printing, they panic into the only asset that is not someone else's liability. They rush for the tip of the pyramid. And here's the terrifying math that veiled wealth wants you to understand today. The top of the pyramid is massive and the bottom is microscopic. Let Wes look at the death zone, layers 6 and 5. The derivatives market, bets on interest rates, currency swaps, options, is estimated by the Bank for International Settlements to have a notional value of around $700 trillion. But if you include shadow banking and off-balance sheet obligations, some analysts peg this number at over $2 quadrillion. That is a 2 followed by 15 zeros. To put that in perspective, the GDP of the entire planet Earth is only about $100 trillion. The paper bets on the economy are 20 times larger than the economy itself. This layer is pure leverage. It exists only as long as banks trust each other. In 2008, a small crack in this layer nearly ended modern civilization. Today, the bubble is bigger, the leverage is higher, and the trust is lower. Below that are the unfunded liabilities. In the U.S. alone, promises for future Social Security and Medicare payments total over $175 trillion. The government does not have this money. It has zero. It relies entirely on the assumption that it can tax future generations or print the difference. Moving down the pyramid, we hit the trap. This is where the middle class lives: stocks and real estate. We are told that real estate never goes down. We are told that the S&P 500 always recovers. And historically, in nominal terms, that has been true. But are these assets going up in value, or is the dollar just losing purchasing power? The Shiller price to earnings, PE ratio, a metric that has successfully predicted almost every major market crash in history, is currently flashing code red. It is showing that stock valuations are the second highest they have been in 155 years, surpassed only by the insanity of the dot-com bubble in 2000. We are in everything bubble territory. And real estate is not liquid. In a liquidity drain, liquidity is the only thing that matters. You might have a home Zestimate of $2 million, but if credit markets freeze and no one can get a mortgage, what is that house actually worth? In the Great Depression, mansions in New York were sold for the equivalent of a few years' rent. In a crisis, real estate becomes a trap. You have to pay taxes and maintenance on it, but you cannot sell it for what you think it's worth. Layer 2 is what Exter called the illusion. This is fiat cash and government bonds. For decades, U.S. Treasuries were considered the risk-free asset. They were the bedrock of the global financial system. But that bedrock is turning into quicksand. The U.S. national debt has crossed $38 trillion. And we are adding $1 trillion in new debt every 100 days. The interest payments on this debt are now the second largest item in the federal budget, exceeding the entire defense budget. We are borrowing money to pay the interest on the money we already borrowed. In corporate finance, this is called a Ponzi scheme. In government finance, they call it modern monetary theory. But the math is the same, and the ending is the same. Central banks know this. That is why they are selling treasuries. They know that the only way the U.S. government can pay this debt is to print the dollars to cover it, which guarantees the devaluation of the currency. Holding cash or bonds guarantees you will be the victim of this inflation. This brings us to the bottom, the foundation, gold. Why gold? Why not Bitcoin? Why not land? Why not art? Because gold is the only financial asset that is not someone else's promise. If you own a stock, you're trusting the CEO and the board. If you own a bond, you're trusting the politicians. If you own a bank deposit, you're trusting the bank's solvency. If you own gold, you are trusting physics and chemistry. It cannot be printed by a central bank. It cannot be hacked by a cyber attack. It cannot be defaulted on. It has no counterparty risk. When the liquidity drains from the $2 quadrillion derivatives market and the $100 trillion bond market and the $100 trillion stock market, where does it go? It tries to squeeze into the gold market. And this is where the opportunity of a lifetime sits. The total value of all the investable gold in the world is roughly $15 trillion. The door at the bottom of the pyramid is tiny. When the panic starts, when the herd turns, the amount of capital trying to move through that door will be astronomical. This is why price predictions of $5,000, $10,000, or even $20,000 per ounce are not fantasy. They are simply the result of dividing the paper money supply by the available ounces of gold. But if gold is the king, silver is the emperor in waiting. At Veiled Wealth, we believe the setup for silver is even more explosive than gold. Silver sits at a unique intersection that John Exter could never have fully predicted. Yes, it is a monetary metal. Yes, it is a safe haven. But in 2026, silver is also the strategic oil of the 21st century. You cannot build the modern world without silver. It is the most electrically conductive element in the periodic table. It is the most thermally conductive. It is the most reflective. We are facing a perfect storm in silver. 1. Solar energy. The world is racing to net zero. Solar panel installation is vertical. A standard solar panel uses about 20 grams of silver. In 2025, the solar industry consumed over 260 million ounces of silver. That is nearly 30% of the entire annual mine supply of the planet. And the technology is shifting to TOPCon cells, which require 50% more silver per panel, not less. 2. Electric vehicles. An EV uses up to 50 grams of silver, twice that of a gas car. Every sensor, every camera, every battery management system needs silver. 3. Artificial intelligence. The AI boom is a hardware boom. Data centers, high-performance chips, 5G networks, they all rely on silver contacts and solders. While demand is exploding, supply is dying. Global silver mine production peaked back in 2016. It has been falling or flat ever since. We have run a supply deficit for 5 consecutive years. Above-ground stockpiles in London and Shanghai are at record lows. And here is the kicker. 70% of silver is mined as a byproduct of lead, zinc, and copper mines. This means silver miners cannot just ramp up production if the price rises. They are bound by the economics of other metals. The supply is inelastic. Now, do the math. The gold to silver ratio is currently hovering near 80. 1. This means it takes 80 ounces of silver to buy 1 ounce of gold. Historically, this ratio is around 60.1. In 1980, it hit 15.1. In 2011, it hit 30. 1. If gold hits $5,000, a conservative estimate in a currency crisis, and the ratio returns to its historical average of 30.1, silver would trade at $196 per ounce. If the ratio compresses to 15:1, as it often does in mania phases, we are looking at 330 silver. From current prices, that is a potential return of 10x or 20x. History doesn't repeat, but it rhymes. In the 1970s, we saw a loss of confidence in the dollar. Gold went from $35 to $850. Silver went from 1.50 to 50. In the Weimar Republic, paper money became so worthless, people used it to burn for heat, while gold bought city blocks. In 2008, the system nearly died, and gold doubled in the aftermath. The signals today are louder than ever before. The debt is exponential. The derivatives bubble is 20 times the size of the economy. Central banks, the insiders, are buying gold at record rates. The industrial shortage of silver is deepening daily. John Exter warned us. He drew the map. The liquidity drain is not a theory. It is a mechanical inevitability of an inverted pyramid system. Gravity always wins. The water always flows downhill. The only question that remains is for you. When the water flows to the bottom, will you be holding the paper promises of a bankrupt system, or will you be holding the only assets that have survived every collapse in human history? The window is closing. The smart money has already moved. Now, it is your turn to decide. Thank you for watching Veiled Wealth. We exist to uncover the truths that the mainstream media is paid to ignore. If you found value in this deep dive, please subscribe and share this video with someone you care about. The more people who understand the Exter Pyramid, the more prepared we will be for what is coming. Stay safe, stay skeptical, and keep watching the flows, not the headlines. We will see you in the next investigation.